Okay guys, welcome to phase 3. In this first video, we're going to cover liquidity, pretty much what it is, how it's used. Okay, so liquidity is a finance term, right, for the people that don't know. And the meaning can slightly vary depending on what exactly you're talking about, whether that's a company, a financial market, or an individual investor or a group investor, just anything along those lines, but it slightly varies, okay? So when you're talking about foreign exchange, right, liquidity in foreign exchange refers to, by definition, refers to a currency pair's ability to be bought and sold without creating a major impact on its exchange rate, right? So a very simplified way of saying that liquidity is money, right? The more liquid a financial market is, right, the more money is in that financial market. The less liquid a financial market is, the less money there's there sitting. Okay, so what does that necessarily mean in terms of charts, right? So we know that the foreign exchange market, right, is the most liquid market in the world, right? And it's multiple times greater than the stock market, right, which is essentially the what everybody knows. Everybody knows what the stock market is. Not everybody knows what the Forex market is. Okay, so what does that necessarily mean, right? What are the advantages of, high liquidity being present in the foreign exchange market in comparison to the lower liquidity? And keep in mind, I didn't say low, I said lower, just because there is still a lot of liquidity inside of stocks. All right, but, pretty much the major advantages of trading in a high liquid market are essentially that transactions, right, trades, buys and sells, can be completed quickly and easily, right, in comparison to other platforms, other financial instruments, which also implies that the transaction costs and the spreads are much lower, right? So obviously, depending on whatever cross you're talking about, right, will be very distinct in terms of liquidity, which is why we tend to stick to majors and minors over exotics, right? If you tend to trade exotics, like, off the top of my head, USD ZAR, GBP, SEC, USD, PLN, just all those exotics, right? You'll notice that there's a lot more manipulation in play, and by that I just mean there's a lot more wicks. You'll see bigger spreads. You'll see, candles not necessarily be filled, and by that I mean, notice how here in your USD, for the most part, right, there is no gaps in between candles, whereas here in this Apple stock you see a ton of gaps, right? So you'll see those gaps a lot more often in you'll see those a lot more often in very low liquid assets, very low liquid currency crosses, right? So like I said, that's why we stick to pairs that are, in the major and minor list. Okay, so now talking about liquidity in the actual chart, okay, because we know that liquidity is money, we know that price must yield and pursue lows to, continue, or highs, right? Obviously I'm saying lows because that's what's shown on the image present, right? So the reason why I pretty much preach structure above all, right, especially that's why it's in phase 1, is because without structure you really cannot read liquidity. You can find liquidity, but you probably wouldn't be able to trade with it, based on it, right, without knowing your structure. So as you can see here, right, I marked out the liquidity present based on X's. Okay, and the reason why I did that, right, is because to me liquidity is a target, because we know that there are orders, whether that's pending orders, current orders, stop losses, anything along those lines. We know those are stuck below lows and highs, right? So it's not a matter of knowing whether or not liquidity is going to be taken. It's a matter of understanding whether or not, it's a matter of understanding when the liquidity is going to be taken. Sorry about that. So as you can see, right, you can see by the blue squares here, right, we have our low, our high, we have our break of structure, then we have our pullback, right? So we then take out that previous structural low here, right, which is liquidity 0.1. So what naturally happens after that, right, after the correction, we have a new impulse, right, you have a new structural range, right, you then have another pullback, and now you're aiming for the liquidity sitting below the previous structural range low. Why? Because we are in a downtrend. Okay, so correction, impulse, correction, new target, impulse, correction, new target, impulse. Okay, so now, right, we're gonna pretty much cover, what equal lows and equal highs are. So with equal lows, equal highs, right, whatever you're talking about, whether it's a low or high, right, the first low and the first high, right, must not be broken by the second or third high or low present, right? What do I mean by that? Well, just looking here, right, a scenario essentially here on USD CAD, right, where we see, right, equal highs because the first high was not broken by the second or third present here, and we see here the low, right, previous low that wasn't taken out by either 1, 2, or 3 lows, right? So even though this low probably took out this low, it still did not take out the overall low. So now the orders pending below this low are now added on to here, making this a much more probable area to be hit in the future, not near future, not long future, in the future, because we don't know. That's something that I have to emphasize, right? Liquidity is not an influencer of bias. Liquidity is only a target. Okay, just remember that. Just because you have equal highs sitting does not mean they're going to be taken out. But if you have signs showing bullishness that are aiming for those equal highs, then now you have a target, right? So just see liquidity kind of like fuel, whereas the market needs that fuel in order to continue, right? Just going back to the initial example, right? Our correction impulse, we take the fuel, we recharge, and then we release, right? We take the liquidity, take the fuel, we recharge, and then we release, right? We take the fuel, we recharge, right? And then we release. Okay, so I guess that's one of the simplest ways I can put it. But back to this example, okay, right? We see liquidity here, right? What happens, right? We see a very, horizontal range here with probably relative equal lows there. Okay, so naturally price will take those out, but it will also pursue these equal lows. Okay, so as you can see, the liquidity has now been taken, right? And we can now go the other direction. Why? Because the liquidity for one direction is now taken, right? We now have the fuel to pursue the other direction. Okay, so what happens here, right? The break of structure, right? The pullback, right? And then we pursue these next highs here. What does that now mean? We've now taken liquidity on both sides. I'm now focusing on the structural range at hand, right? We just see the correction, which then creates bullishness. Okay, so just keep in mind, right, that liquidity will never ever be your influencer of a bias, right? But right, if you're, let's say, trying to buy equal lows, right, keep in mind that the bearish order flow, which we will cover also in this later in this section, right, if that bearish order flow is still intact, then it's going to take those lows, right? It doesn't matter what you're playing off of, how you're playing it, right? See these kind of as magnets. The only issue is we don't know the time, right? Because remember that pretty much every move is manufactured. Every move has a reason to it, right? But we don't know the timing, right? Which is why we can only play based on our advantages, right? Keep in mind, right, that because we're using TradingView, we're bounded by price, we're bounded by time, right? And we're bounded by the candle structures shown. Okay, that means that we don't know exactly where the money is coming from, or how it's managed, right? So we can only play based off our strengths, right? So here, right, because we see this trading range, we see the inducement take out equal lows, right? But we still acknowledge there's equal highs. So I'm not going to try to sell here, right? Because I'm also paying attention to structure here, right? There is a high, there is a low, there is a high, and there is a low. Right, so it's equal highs. So if I'm still trying to potentially play any type of POI, I would much rather have that than try to sell based off of that. Okay, because as you can see, right, as you can see here, if you wanted to sell, right, you would have gotten that reaction, right? But because that bullish order flow is now in play based off of taking out liquidity here, right, this reaction is only a pullback to then take out that liquidity there, right? So hopefully it's not too confusing. But we see this, a large amount of times just due to the fact that we have so much liquidity in this market. Okay, another example here, right, with Euro GBP, right? So we see equal highs, we see equal lows. Okay, what happens? The equal highs, right, are taken here, right? We then have essentially equal lows come into play, right? We now have an unwillingness to continue higher, right? We also have equal lows here. So what happens? We drive price is driven, to take out equal highs, right? You could say we have now caught the orders that created that final move, right? Which creates the release to the downside, right? So taking the fuel, right? We recharge and then we release, right? Just very simple. But for the most part, just look at liquidity, right? Refer to it as money, right? Not as something that influences your bias, right? And it can be a bit contradictory, because you probably won't buy sometimes because you see equal lows, right? But that's for you to do your own research and make your own judgments, okay? So other than that, right, there isn't really much to cover here. But just keep in mind, right, that when you have those equal lows, those equal highs, right, make sure that that second high, that second low does not take out the first one, because then that could be easily misinterpreted as a liquidity grab, which we covered in the previous sections, right? So when you're talking about high probability liquidity points, always look for, that second or third low or high to not take out the first one. And obviously, as the higher the time frame you're on, the more secure it is. Okay, so that pretty much wraps it up for this video, and I'll see you guys in the next one.